Intel reported quarterly financial results that beat investor expectations, and already the stock price is up over 89% year to date in 2025. And of course, I'm happy about that because I've had Intel stock rated as a buy all year long. So I'm happy to see the success of this company that I rated as a buy. In this video, I'm going to review the company's latest quarterly financial results, highlight the things that you need to know as an investor about Intel's quarterly earnings results, and I promise you these are things that mainstream media have not covered. I go into detailed financial analysis, so you're going to want to tune in and see these details if you own Intel stock or if you're interested in owning Intel stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So some of the obvious items, third quarter revenue came in at 13.7 billion, which was up 3% year over year. That was better than management was expecting. And looking ahead for the fourth quarter, management doesn't expect these excellent results to continue. They're forecasting fourth quarter revenue of 13.3 billion at the midpoint, which would be 400 million below the current quarter result. The management team saying that AI is accelerating demand for compute and creating attractive opportunities across our portfolio, including our x86 platforms and new efforts in purpose-built ASICs and accelerators and foundry services. The last part is the part where Intel has invested tens of billions of dollars expanding and improving their manufacturing capabilities, not only for internal use cases, but they want to be able to sell their manufacturing services to third parties, companies like AMD or Nvidia. Intel wants to sell them its manufacturing services because Nvidia and AMD, they don't have any manufacturing in-house. They outsource that to companies like Taiwan Semiconductor Manufacturing Company. So Intel has invested aggressively to try and take some market share away from Taiwan Semiconductor. Now, here's the important progress the company made during the quarter, and that was on the balance sheet. The CFO saying they took meaningful steps this quarter to strengthen our balance sheet, including accelerated funding from the US government and investments by Nvidia and SoftBank Group. And of course, I reported on all of these developments, and each one of these sent Intel stock price soaring when the news was announced. Here's a surprising statement for me. The CFO saying that current market demand is outpacing supply, a trend we expect will persist into 2026. Now, this is something I've been hearing from other AI companies, but not Intel. Intel has been saying the opposite, how they've invested in expanding their manufacturing capacity and they're struggling to capture demand. They're struggling to make sales. And so this was a new sentiment here from the CFO, and I've yet to see this in their quarterly operating results. So maybe he's talking about looking ahead, current demand is outpacing supply. So maybe talking about 2026, the order book, the backlog compared to how much capacity they have, looks like it's outpacing supply, which is great news for Intel stock investors. So one of the areas where Intel has been paying close attention is on the operating cost side, signaling to investors that they aim to cut costs by billions of dollars, and they've already started to do that, making great progress on this front. You can see here, as of September 28th, 2024, they had 115,000 employees. That fell to 96.4 thousand as of June 28th, 2025. And then just in the previous 3 months, they let go of an additional 13,000 people. Now they're down to 83,300. Management has noted that they plan to get down to 75,000 employees. And so they're well on their way. They're about 10% left of reduction for employees to get to that desired total employee count. Now, Intel hasn't been announcing very many mass layoffs, but there's other ways you can reduce your headcount without announcing big layoffs, and that's by attrition and not replacing people that quit, retire, or change to a new company. You just don't replace them, you don't hire, and you let attrition take care of reduction in headcount. So investors interested in Intel have to consider the balance sheet. In most cases, a company's balance sheet is not very important to the investment case because you already know the company has a great balance sheet. And so incremental changes in the balance sheet doesn't make that big of a difference. Companies like Palantir and Tesla, they have absolutely excellent balance sheets. So incremental changes there, not very big deal in terms of the investment thesis. But for Intel, it is a big deal because of the company's recent history. The former CEO, Pat Gelsinger, spent tens of billions of dollars on enhancing and improving the manufacturing capabilities. The company didn't have that money internally, so they borrowed a lot of money and they were generating significantly negative cash flows every single quarter for many, many quarters. But now, with the investments from Nvidia, the US government, SoftBank, and the improvements in their cash flow from operations, the balance sheet is improving. So, since December 28th, 2024, their cash and short-term investment balance, you can see the combination of the two, was about 22 billion as of December 28th. That improved as of September 27 up to about 31 billion. So from 21 billion to 31 billion, an improvement of roughly 50% or $10 billion in cash and short-term investments. This is strong. This shores up the balance sheet for a company where investors were very worried about the balance sheet. The balance sheet was one of the reasons why Intel had to pause its dividend, reduce the dividend payments to investors because they were worried about running out of money. So on the debt side, they also made improvements there, reducing their long-term debt from 46.3 billion down to 44 billion. So a reduction of about 2.2 billion on the debt side of the balance sheet. And this is relatively high interest debt. When you're borrowing money in a situation where your balance sheet is dangerous, you're paying higher interest expenses. And so undoubtedly, Intel's management team now is focusing on reducing the long-term debt, the highest interest payment long-term debt, wherever they see they can opportunistically reduce debt. And here's another interesting point I wanted to highlight that you're probably not hearing in very many places. And it's about debt and improving stock price. So you've noticed Intel share price is up meaningfully year to date in 2025. I highlighted in the introduction of the video, it's up 89%. And I said I'm happy about that because I rated Intel as a buy. One of the reasons why it's up so much, even though the improving business has not justified that kind of increase, is because of the leverage you get when you're a highly indebted company. And that's because of the way your capital structure works. When someone lends you money, they are entitled to a fixed amount in return. So when you borrow money, you promise to pay whatever it might be, 6%, 8%, 10% to your lender. Now, if your business does better and your business gets all these great contracts and sales improve and things are going great, guess how much your lender gets? The same amount that was promised. So regardless of whether you do wonderfully or whether you do terribly, the lender is still entitled to the same amount. And so that's why when you have a highly indebted company and it achieves accelerating success, the stock price improves by a larger magnitude because more of those gains are going to equity holders, to stockholders. And there aren't that many stockholders proportionally when a company is highly indebted because the capital structure, the business is financed with a larger percentage of debt and a smaller percentage of equity. So when there is success, equity holders experience an outsized gain as a result of that success. You saw similar results from a company like Oracle, right? They're also a highly indebted company, and their success this year, their outperformance this year, is partly due to the fact that they are highly indebted. And so a lot of their gains went to the equity holders, and the lenders are still entitled to the same amount. Now, that being said, the opposite is also true. The opposite is also true. So if Intel performance deteriorates, then shareholders will experience the major negative impacts of that negative performance. So it multiplies the performance to equity holders when a company is highly indebted, which makes it riskier because If things go well, the stock price goes up by a larger amount. If things go poorly, the stock price goes down by a larger amount. So it's a riskier business. And right now, things are going well for Intel, and the stock price is jumping by an outsized amount. So all that being said, I'll remind you, I had Intel stock rated as a buy. I last updated that recommendation on October 1st. Do I still think the stock is a buy after these results? The answer is yes. I still like Intel stock. The company is right now just getting started, reaping the benefits of those tens of billions of dollars they invested in manufacturing capacity and manufacturing enhancement. So, great news for Intel stock investors that the company is starting to achieve this success, and hopefully more great times to continue. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.